everyone, welcome back. So in this chapter we're going to be looking at a merchandising business. Up until this point we have been preparing financial statements and journal entries for a service type of business, right? Something that where we mowed a lawn and we earned money, or we prepared a tax return or something like that. We weren't actually selling products. So now what we're looking at is a merchandiser who is selling products, right? This is your Target, this is your Amazon, things like that. All right, so what is a merchandising business? Well, in the merchandising business, what you do is you buy goods at wholesale. You buy them from, from the distributors, and you turn around and you sell those goods at a retail price. So maybe you bought a pair of jeans for $10 from Levi's directly, and you turn around and sell them in your store for $18. Right? That difference there is the difference between wholesale, what you paid, and the retail price, and that difference is known as the markup. Now, with this, we're going to be looking at inventory and things like that, but there's also some terms that you haven't heard yet that we're going to touch on, some of the new accounts we have for merchandising businesses. So the first one is sales revenue. It's got the word revenue in it, right? So you know it's something you earn. Well, sales revenue is revenue from the sale of merchandise. Up until this point, we've been doing service revenue. Well, now we're doing sales revenue because that's what we're doing to make money. We're selling things. The other new item, one of the new items, is cost of goods sold. Cost of goods sold is the cost of selling your products, right? So now if you think about it, let's say your Target, you have to go out there and buy that $10 pair of jeans, right? And then you have to sell that $10 pair of jeans, right? You sell it for $18. But that $10 pair of jeans is the cost of the goods that you're selling. It costs you $10 to acquire those jeans, and then you're going to turn around and sell them for $18. All right? So you would have sales revenue of $18 and cost of goods sold of $10. Right? So what cost of goods sold is it's treated like an expense, and it's really the biggest expense in your income statement. And it's the cost of the products or the inventory that you're selling. All right? You also might see COMS, which is cost of merchandise sold. All right, well, more on cost of goods sold as we move along. The other one, as I said, was inventory. We haven't had inventory yet, right? We haven't been selling products. Well, now we are. So merchandise inventory is going to be referred to as the inventory we're holding for sale. It is a current asset and it lives on our balance sheet. All right. Sales revenue and cost of goods sold, they live on the income statement. All right. So like I said, before we had the standard service type of business, right? And all we really had was service revenue and all of the expenses subtracted from service revenue. That was that simple type of income statement was just all revenues minus all expenses. That's referred to as a single step income statement. What we're going to be looking at now is we're looking at what's called a multi-step income statement, which is more standard for merchandising business. We start off with sales revenue, as you might have expected. And from sales revenue, we subtract cost of goods sold. Right? That gives us a term called gross profit. I would say arguably that's one of the two most important terms on your income statement, gross profit, and I'll get to the second one. Gross profit is how much you made on that sale, right? So if I was back to that pair of jeans, if sales revenue was $18 for the pair of jeans, the cost of goods sold, it cost me $10 to buy that pair of jeans, then the profit, the gross profit I made on that sale was $8, right? You have to be able to mark up your products enough. You may need to make enough of a gross profit on your products that $8 that we made on that pair of jeans has to then pay for all of the rest of the cost of running our business. Right? So this gross profit number has to be set sufficiently high to earn us enough money that we can pay for all of the other expenses that go along with running a business. All right, so that gross profit number is a really important one to watch. From there, we subtract selling and administrative expenses. Selling expenses are going to be things like cost of the store, sales salaries, advertising costs, things like that. And administrative expenses are going to be just those, the cost to run your business, right? The cost of the payroll department salaries and the people who run the CFO and the CEO, right? The people that are running the business, right? Those two together are what's known as operating expenses. Now, what you do is you subtract, right? You have all this profit, this gross profit number, and we subtract all of those operating expenses, which are all the costs of running our business. And that comes out to be operating income or income from operations. And that's your second really, really important number, right? Operating income basically says, did we make money doing what it is that we do, right? did we make money? Do we have income from our operations of our business? Okay, so if anything, this number is really important and this number is really important. From there, we actually have a little bit more. We have plus minus other revenue, other expenses. What falls in others? Well, things that fall into others are things that are not necessarily part of our core business operations. Let's say that we're Target, right? You know what our business is. Our business is selling things, right? Selling merchandise. Our business is not to, let's say, rent out a parking lot. Let's say we happen to have an empty parking lot we're not using, and somebody comes to us and says, hey, can we rent your parking lot? And we're like, sure, we're not doing anything with it. And they give us money. Let's say they give us $10,000 to rent our parking lot for the year. That would be other, right? Because that's not part of our core business operations. Another thing that typically falls in other revenue, other expenses, are things like interest expense or interest revenue, because borrowing and loaning money is also not part of a merchandiser's core business operations. All right, from there, we have income before taxes. Okay, so we kind of subtotal it right before we get to that magic tax number that everybody has to subtract out there. So we separate out income tax expense. It is a separate line item. It's significant. It's not one that's avoidable. So we separate it out. And then we come to that final net income number. Okay, so with the merchandiser's income statement, we do these subcategories here where we stop at gross profit, and we stop at operating income, and then we stop at income before taxes, and then we stop at, well, then we finally stop at net income. All right, so we have a couple of subcategories in there. All right, all right, so I was going to ask any questions, but really, it doesn't work that way. All right, so just to kind of give you an idea of how gross profit looks, right? I kept using the jeans as my example, but I'll give you a real example here. It says your car dealership buys 8 cars for $20,000 each and sells 5 of them for $25,000. How would we show inventory and gross profit appear on the financial statements? Now, this is a good point to say. Inventory is going to be one of two places. Inventory is going to be unsold and on your balance sheet, or you're going to sell it and it's going to be on your income statement. Okay, so it's one of those two places. It's either on your balance sheet, right, as an asset in your inventory, or it's going to be sold and the dollar amount there will be captured as cost of goods sold. Okay, so let me show you with these numbers. All right, so we're looking at inventory and gross profit. Balance sheet, income statement. So the inventory, we bought 8 cars for $20,000 each. We sold 5 of them. All right, that means we've got 3 cars left, right? We've got 3 cars left as inventory of $60,000 that we did not sell. That's what those are the unsold ones. Now we have to account for the ones that we did sell. So this here's our beginning, right? Sales minus cost of goods sold gives you gross profit. Well, the sales price, we sold 5 of them for $25,000. And something just dropped downstairs. And we have our cost of goods sold. We sold 5 of them, and our cost was $20,000 for each one of those cars. That makes our gross profit $25,000, right? So the cars are one of two places. We had 8 of them, so we have 3 that we haven't sold yet and 5 that we did. So the cost of goods sold captures that inventory value of the ones that we did sell. Okay. All right. So here's a little try it. You can pause yourself, try to go through it on your own. Pause me. And then you can come back and you can go through this and make sure you have all the same solutions. All right, move on. All right, here we go, inventory systems. Now inventory, we're going to go into inventory in great detail in chapter 6, the next chapter. But for now, we're just going to kind of topside it. Inventory systems, what we do is we keep track of inventory based on how many units of inventory we have and what the cost per unit is. All right, so there's going to be a couple of different ways we do that. And again, that's chapter 6, but we do keep track of the number of items of inventory we have and what it costs us to obtain that inventory. Okay. We are also going to look at 2 different types of inventory. Well, I take it back. There are 2 major types of inventory systems, perpetual and periodic. Perpetual is your norm. Perpetual is like your major stores. Really, any of your stores that pretty much scan inventory as it comes in and out. Right, as you go through, and whether you're a Quick Check or whether you're at Target or whether you're, I don't know, Costco, right? Perpetual inventory system means inventory records are being constantly updated. Every time there's a sale and it goes through the register, inventory gets updated in the systems. Every time there's a purchase, inventory comes on the loading dock, it gets updated. That's perpetual inventory, right? Think about perpetual motion. You're constantly updating the numbers. Periodic, you're updating your inventory numbers periodically, once in a while. All right, that once in a while is not something that you see all that often anymore. That's something like if you got these little mom and pop stores, right, and they don't have scanners and they're plugging things into an old-fashioned cash register. Again, not something you see very often, or at least not in this area of the world. But those people, what they have is they track their inventory with a periodic system. Maybe they count their inventory once a month and they update their records at that time. That's not terribly commonplace. So when we are doing inventory examples, we're going to be focusing on the perpetual method because that's just simply more common. All right, so I'm going to pause here for a second and I'll see you in the next video.